In the news this week, now you see him, now you don't. Wait till you hear what the Labor Department did with jobs. Is Jerome Powell finally ready to make a move? And a widely followed economic indicator won't stop sinking. Let's dive in. Before we begin, remember to like this video and subscribe for more economic updates. All the conventions are over. We will, of course, keep an eye on the campaigns as they develop, especially as each side makes their case for how they plan to improve an economy burdened with more than its share of struggles that apparently include making sure Americans are getting the straight story when it comes to the official economic data. The Labor Department announced on Wednesday that job growth in the 12-month period ending March 2024 had been massively overstated by the government's official monthly numbers. According to the revised calculations, the country added 818,000 fewer jobs than previously estimated from April 2023 to March 2024. That reduces average monthly job growth over the period from about 242,000 down to about 174,000. The adjustment marks the largest downward revision to jobs numbers in 15 years. Analysts attribute inaccuracies in the monthly employment data to persistently poor collection rates. According to economist Stephen Moore, a downward revision on this scale potentially paints a far different picture of the economy than the one Americans thought they were living in. Moore said, "If it's close to 1 million, that means that the American economy has performed a lot weaker than we have been saying for the last couple of years." The week's other major news story was Federal Reserve Chair Jerome Powell's keynote address at the Kansas City Fed's annual Jackson Hole, Wyoming Economic Symposium. Speaking on Friday morning, Powell made the declaration so many have been waiting to hear since the central bank raised rates to 23-year highs in July 2023. "The time has come for policy to adjust," said Powell, who added, "The direction of travel is clear." But Powell also refused to provide any specifics about when cuts would begin or their anticipated size, saying, "The timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks." Markets don't appear to be buying any hedge language from the chair at this point. Right now, they're estimating the probability of a rate cut in September at 100%. As for the size of the possible reduction, traders right now say there's a 65% chance of a 25 basis point cut and a 35% chance of a 50 basis point cut. Finally this week, in February, the Conference Board walked back its long-standing recession forecast, citing the overall resilience of the economy. But that hasn't stopped the board's headline metric, the leading economic index, from continuing to fall. On Monday, the board reported that the LEI fell 0.6 of a point in July, twice the decline projected by economists. The drop marked the 27th time in the last 28 months the index has fallen. Despite last month's result, the Conference Board still says recession is off the table. However, in a statement, the board said it does expect GDP in the third quarter to come in at an annualized rate of just 0.6%, and GDP in the fourth quarter to come in at 1%. That's it for now. Make sure to come back on Monday when we continue to give you all the economic updates. This is Devlin Steele for Augusta Precious Metals signing out.